two people, same starting income, same city, same year. 10 years later, one has a net worth of $1.2 million. The other has $34,000 in credit card debt and nothing in saving. Same income, different relationship with one word: debt. Everything you were taught about debt by your parents, your school, your bank was designed to keep you using it the wrong way, the expensive way, the way that makes other people rich off your payments. This video is the lesson they never gave you, and the final section alone is worth more than anything most people will ever pay to learn. Here is the entire game in one sentence. Regular people borrow money to buy things that lose value the moment they touch them. The wealthy borrow money to buy things that make more money than the cost of the loan. That is the entire wealth gap hiding in plain sight. Right now, the average American carries over $6,000 in credit card debt at interest rates above 22%. That is borrowed money used for groceries, gas, Amazon orders, things already consumed. Meanwhile, a real estate investor borrows at 6% to buy a property generating 10% returns. A business owner takes a loan to buy equipment that produces cash flow. In both cases, the debt costs less than the asset produces. That difference between what you pay to borrow and what you earn from borrowing is where wealth compounds in silence. Now let us go higher, because what the ultra wealthy do with debt is even more counterintuitive. There is a 3-word strategy on Wall Street known as buy, borrow, die, and it is completely legal. It is how billionaires access enormous amounts of cash without selling assets and without triggering massive taxes. Here's how it works. First, you buy appreciating assets. Then you never sell them. Instead, you borrow against them because loan proceeds are not taxable income. That means someone can access billions in liquidity while technically showing very little taxable income. And when those assets pass to heirs under current tax law, the original capital gains can disappear entirely. This is not a loophole. These are features of the American financial system. The wealthy simply understand the rules. Most people never even learn the game exists. Now let us make this real. You have $50,000 saved. Option 1, you place it in a savings account earning 4%. After 1 year, you make a few $1,000s. Option 2, you use that same $50,000 as a down payment on a $250,000 rental property. Now 3 things happen at once. First, cash flow. Your tenant pays rent every month. Part of that money pays your mortgage, which means someone else is building your equity. Second, appreciation. If the property rises in value, you benefit from gains on the full property value, not just your original $50,000. Third, tax advantages. Depreciation, mortgage deductions, and exchange rules that legally reduce taxable income. The bank lends the money, the tenant repays the loan. The property appreciates over time. That is leverage. And leverage is one of the most powerful wealth-building tools in modern finance. This is the concept that separates people who understand money from those who do not. Interest rate arbitrage. And it is devastatingly simple. If you can borrow money at a lower rate than the rate at which the asset grows, you profit from the spread every single year for decades. Historically, major market indexes have returned around 10% annually. Meanwhile, mortgage rates and business loans have often remained significantly lower. That gap is the engine. Now compare that to credit card debt. People borrowing at 22% to buy things that immediately lose value. Negative spread. The wealthy operate on positive spreads. Most people operate on negative spreads and call it normal. It is not normal. It is one of the most expensive habits in America. Now, something important, because this is not just about personal responsibility. Total American credit card debt has exploded into the trillions. And much of that debt is not luxury spending. It is survival, groceries, rent, utilities, healthcare. The average household now pays thousands every year in pure interest, money disappearing just to stay afloat. And here's the brutal reality. The wealthy access capital at extremely low rates. The poor pay the highest rates in the system. The people with the least money are charged the most for access to money. That is not emotion. That is arithmetic. And understanding that arithmetic is the first step toward escaping it. You do not need to be a billionaire to understand this system. The principle scales all the way down. First, eliminate high-interest debt. Every dollar trapped at 22% interest is a dollar that can never compound for you. Second, protect and improve your credit score, because your credit score determines your cost of capital. Third, never borrow unless the expected return exceeds the interest rate. That single rule changes everything. And finally, understand this. Your first real asset is not status, not appearance, not consumption. It is ownership. Ownership of assets that continue working while you sleep. That is the shift. That is the mindset. And that is how debt transforms from a trap into an engine. The game was never hidden. The rules were always public. The tax code exists. The financial products exist. The market exists. What most people never received was the map. The realization that debt can either drain your future or accelerate it. Now you see the system differently, and once you see it, you cannot unsee it. If this changed the way you think about money, there is much more ahead, because the next lesson is not about how money is earned. It is about how the system decides who keeps it.